MicroStrategy has borrowed tens of billions to buy Bitcoin, and right now, its average purchase price is above the market. For most investors, that sentence alone triggers one conclusion: they will be forced to sell. But that conclusion is wrong. Because MicroStrategy is not structured like a trader, it is not built around margin calls, and it does not live or die by short-term price moves. What looks like leverage is actually a capital structure, and that distinction changes everything. This is not just a company holding Bitcoin, it is a machine that converts equity volatility into permanent ownership of a scarce asset. In bull markets, that machine looks unstoppable. But when momentum fades, the same mechanism can begin to work in reverse. And the real risk is not a Bitcoin crash. It is something far slower, far quieter, and far more dangerous. Hi everyone, you're watching Global Macro and Crypto. Today, we break down how MicroStrategy actually works, why short-term price drops do not trigger forced selling, and the one structural shift that could bring this entire model to a halt. Because once you understand how this machine is built, Bitcoin's day-to-day price may matter far less than the market believes. To understand the situation, we need to start with the concern that dominates nearly every conversation around MicroStrategy: the cost basis. It is a matter of public record that the company continued acquiring Bitcoin aggressively, even as prices push toward all-time highs. When markets correct, as volatile assets inevitably do, newer purchases can temporarily sit at a loss. In isolation, that looks like a bad trade. But viewing MicroStrategy as a trade is the first analytical mistake, because MicroStrategy is not a hedge fund facing monthly redemptions, and it is certainly not a retail trader operating under maintenance margin requirements. That distinction changes everything. Before we go deeper, pause for a moment and consider this. If Bitcoin dropped 30% tomorrow, why wouldn't the company be forced to sell? The answer lies in the liabilities. When retail investors use leverage, they are borrowing from brokers or exchanges with clearly defined liquidation thresholds. Fall below the line, and the position is closed automatically. Capital disappears in real time. It is less like investing, and more like walking a tightrope where the rope can be cut without warning. MicroStrategy operates under a completely different architecture. Instead of margin loans, the company raises capital primarily through convertible senior notes, long-dated debt instruments with low interest rates and maturities, often stretching close to a decade into the future. Retail leverage is like renting an apartment where the landlord can evict you the moment property prices fall. MicroStrategy locked in something closer to a fixed mortgage. The market value of the house can fluctuate wildly, but the bank does not knock on your door every time Zillow updates. This single structural choice transforms the entire risk profile. Debt holders cannot force the liquidation of Bitcoin simply because the price dips this week or this quarter. There is no margin trigger, no automatic collateral seizure. The company's contractual obligations are straightforward: make the interest payments, and repay or convert the principal when maturity arrives. And relative to the scale of the Bitcoin position, those interest payments are modest. What this creates is a form of time arbitrage. Imagine volatility as a violent storm. Retail traders are navigating it in small fishing boats, constantly at risk of capsizing. MicroStrategy built a cargo ship designed for long ocean crossings. It does not avoid storms, it survives them. As long as the company maintains enough cash flow to service the debt, the volatility of Bitcoin becomes largely decoupled from near-term solvency. This is why the popular narrative that a short-term drop in Bitcoin will trigger forced selling reflects a misunderstanding of corporate finance. Price matters, but structure matters more. The real risk is not Bitcoin at 50,000 or even 40,000. The real risk is whether the company can maintain long-term access to capital markets, specifically the ability to refinance, roll over, or convert debt as maturities approach. And if you have followed the logic so far, a deeper realization should be forming. The market is evaluating MicroStrategy through the lens of a retail trading account. That lens is completely wrong. There is no forced selling tied to spot price movements. What matters is time, capital structure, liquidity access. And this is where the strategy stops looking like a leveraged Bitcoin bet and starts resembling something far more sophisticated. Because now, we arrive at the true engine behind the model, what the internet jokingly calls an infinite money glitch. In financial terms, it is a continuous capital-raising mechanism driven by one critical variable: the premium to net asset value. In a perfectly efficient market, a holding company should trade roughly in line with the value of the assets it owns. If a firm holds $10 billion in Bitcoin, logic suggests a valuation near $10 billion. But MicroStrategy is often traded at a significant premium to the market value of its holdings. In other words, investors are willing to pay more than $1 for $1 of Bitcoin exposure. Why would rational markets allow that? Several forces are at play. Some institutional investors cannot hold Bitcoin directly due to mandate restrictions. The equity becomes a proxy. Others believe the company's capital market strategy can increase Bitcoin exposure per share over time. Regardless of the reason, the premium exists, and management uses it. Think of it like owning a machine that can print $100 bills for $80. As long as the machine works, you run it. When the stock trades well above the value of its Bitcoin, the company can issue new shares at that elevated valuation. Those shares bring in dollars. Those dollars buy Bitcoin at market price. Because the shares were sold at a premium, the transaction increases the Bitcoin backing each remaining share. This process is called accretion. Ownership percentage is diluted, but asset value per share rises. It is counterintuitive, and that is precisely why many investors miss it. The mechanism creates a positive feedback loop. Higher Bitcoin per share can justify the premium. The premium enables further issuance. Issuance funds more Bitcoin purchases. The equity market effectively becomes a funding engine. Volatility in the stock is converted into permanence in the underlying asset. Step back, and the strategy begins to resemble a bridge, channeling the deep liquidity of fiat equity markets into a digitally scarce asset with fixed supply. There is also a broader macroeconomic expression embedded here. By borrowing billions at fixed, relatively low rates to acquire a provably scarce asset, the company is effectively positioning against long-term currency debasement while accumulating something designed to resist supply expansion. It is the same logic behind taking a 30-year mortgage during an inflationary era. You repay the loan in future dollars that may be worth less, while the asset potentially reprices higher in nominal terms. But here, the concept is executed on an industrial scale. The balance sheet is not neutral. It is explicitly aligned with long-term liquidity expansion. However, analysis without risk assessment is just marketing. And this is where tension enters the story. Because the primary vulnerability is not Bitcoin's price. It is the compression of the premium. If the market decides it no longer wants to pay extra for MicroStrategy shares, the engine slows. If the stock trades at net asset value, or worse, at a discount, issuing new shares stops being accretive. Under those conditions, equity raises begin to dilute Bitcoin per share rather than enhance it. The machine that once created value starts destroying it. And once that shift happens, management faces a very different strategic landscape. Now, consider what is quietly changing in the background. As spot Bitcoin ETFs become globally accessible, the need to use an operating company as a proxy weakens. Why pay a premium when you can buy exposure at net asset value? To justify that premium, MicroStrategy must consistently prove that its strategy creates more shareholder value than a passive vehicle. If it fails, the premium compresses. And when the premium collapses, the accumulation phase ends. There is also the possibility of a reverse feedback loop. In a prolonged bear market, a discount can amplify equity volatility, eroding confidence and limiting strategic flexibility. The debt may not be callable, but perception still matters in capital markets. Confidence is liquidity. Lose one, and the other follows. Another layer of complexity sits in governance. The accumulation strategy is driven by leadership conviction, supported by a voting structure that concentrates control. For investors, this is both strength and risk. It provides insulation from short-term activist pressure, but reduces internal friction if conditions change. Boarding this equity is less like voting on every course adjustment and more like stepping onto a ship with a predetermined destination. You trust the captain, or you do not board. The relationship between the legacy software business and the treasury strategy is equally critical. The software segment generates the cash flow required to service debt obligations. It is the heartbeat beneath the financial architecture. If that heartbeat weakens meaningfully, even modest interest payments could grow heavier. Asset sales remain unlikely, but no serious balance sheet analysis assigns a zero probability to stress scenarios. Zooming out further, this entire experiment exists within a macro environment defined by uneven liquidity and persistent searches for purchasing power preservation. Financial assets increasingly behave as stores of monetary energy rather than simple claims on productivity. Corporations are adapting. MicroStrategy has positioned itself as a prototype for a new form of corporate treasury management. If it succeeds, others may follow, likely with less leverage, but similar philosophy. If it fails, it will stand as a cautionary tale of financial excess. Either outcome makes it historically significant. Short-term volatility is simply the cost of admission. Institutional investors who understand the structure are not reacting to every 10% move in Bitcoin. They are studying maturity ladders, capital access, and volatility tolerance. Retail panic often tracks price. Professional capital tracks survivability. There is also a subtle symbiosis developing between the company and the broader market. Consistent buying absorbs supply, yet simultaneously concentrates ownership. Crypto culture celebrates decentralization. Capital markets naturally drift toward accumulation. That concentration introduces psychological fragility, even when legal liquidation risk remains low. As this cycle evolves, MicroStrategy's performance may increasingly decouple from Bitcoin's day-to-day price. Instead, it will hinge on equity volatility, investor risk appetite, and capital market openness. In a sense, the company has transformed itself into a volatility merchant, monetizing the gap between fiat inefficiency and engineered digital scarcity. So, where does this leave us? The claim that the company is underwater is technically correct, but strategically, it may be beside the point. This is not a game measured in quarters, it is measured in decades. The inefficiency that allows billions to be raised against a finite asset will not persist forever. Markets tend toward efficiency over time. Premiums compress, arbitrage closes, cycles mature. Until then, we are witnessing one of the most aggressive financial experiments of the modern era, a leveraged wager on the future architecture of money itself. A bet that fiat purchasing power continues to erode, and that digitally scarce assets absorb the overflow. And remember the scenario we hinted at earlier, the one risk that could truly destabilize this model? It is not a sudden Bitcoin crash. It is the slow, structural disappearance of the premium. Because without the premium, the engine stops turning. The strategy does not explode. It simply loses lift. In the next video, we're going to decode what Kevin Warsh's nomination could mean for markets, for risk, and most importantly, for your portfolio. Thanks for watching Global Macro and Crypto. I will see you in the next one. If this added clarity to your perspective, hit like and subscribe. Now, let me ask you this. Own Bitcoin directly, or own a company built to out-accumulate everyone else? Which side of that trade do you actually want to be on? Leave your view in the comments below. This content is for educational purposes only and does not constitute financial or investment advice. Always do your own research.